Welcome back to part 2 of How to Beat Inflation in Retirement. I'm your host, as always, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter in retirement. So, in case you missed the first video, I discussed 3, as I define them, offensive strategies for beating inflation in retirement. And I'll go through those real quickly here in case you missed that first video. So, number 1 is to start a side business to generate additional income. Number 2 is to use your investments wisely, that is, pull from the correct buckets and asset classes to optimize your long-term return. And number 3 was implement tax savings strategies. In today's video, what I want to do is talk more about what I like to call defensive strategies for beating inflation in retirement. Now, I define the other ones as offensive simply because if you implement them, they were a little bit more proactive, and also the results, depending on your situation and the outcome, could potentially result in a higher after-tax return that surpasses the rate of inflation. So not just necessarily keeping up with inflation, but literally crushing it, like outpacing it substantially. So today what I want to do is focus mostly on those defensive strategies. And those are the ones that are going to help you ensure that your portfolio, that your wealth, at least maintains pace with inflation and maybe even surpasses it to some extent. So let's just dive right into number 1. So first defensive strategy to beat inflation in retirement is review your investment portfolio and modify accordingly. So what do I mean by that? If you have, let's say, a traditional 60-40 portfolio that you've held for some time and it worked incredibly well in, let's say, a 2% inflationary environment, well, that same portfolio might not work as well when inflation or CPI is running at close to 6 or 7%. So as such, it probably makes sense to review your asset allocation, review your investment portfolio, and make sure that it's up to date and current with what's going on in the economic environment, what's going on with inflation. So I'll give you a couple examples here in certain asset classes that you may want to consider. So number 1 is simply just stocks. Stocks have held up historically very well. They've been one of the best asset classes for outpacing inflation, and specifically those stocks that are able to pass on the rising input costs to the end consumer. And a good example of this is actually McDonald's, and they've successfully increased the price of their Big Mac burger. I think it's like 22% since the pandemic. And now I'm not saying invest in McDonald's per se, but look at your allocation, look at your stock allocation, and make sure that you have exposure to companies that are able to not only absorb those rising input costs, but also benefit from them. And that could be simply a basket of semiconductor stocks held in a low-cost ETF, or simply a broad-based S&P 500 fund that has a higher weighting to maybe the consumer discretionary or consumer cyclical stocks. Another asset class that has done well in inflationary periods is commodities. So you think of gold, you think of silver and copper. Those types of investments historically have done well in inflationary periods, albeit with some risk. And if you own commodity, if you own a commodity strategy, whether it's focus on just gold or a broad basket, you have to be comfortable with stomaching some of that volatility because they can be somewhat volatile depending on the type of strategy that you choose. And lastly, so we kind of covered stocks and we covered commodities. Now, how about fixed income? How about your bond allocation? So what do we do there? Well, typically, if you have just a regular treasury bond or a corporate bond, you're just going to get that fixed coupon payment, right? It's not going to adjust up or down. But with treasury inflation protected securities, or TIPS, those bonds are adjusted up or down based on CPI, or the Consumer Price Index. So if you have, let's say, a diversified portfolio of bonds, and you have some exposure to tips, then at least you know that that portion of your fixed income bucket, if you will, is generally going to maintain pace with the rate of inflation. Now, I only covered 3 different asset classes here, and there's probably not enough time in this video to go through everything that you could consider investing in to maintain pace with inflation. And really, what matters most is not necessarily picking the right stock fund or the right commodity, whether it's gold or silver, but rather just the act of reviewing your investment portfolio and ensuring that your strategy accounts for the current changes in the economic environment. Number 2 defensive strategy is to get clear on your spend and adjust around what matters most. Now, notice how I didn't necessarily say cut back on everything. I think that's like a knee-jerk reaction that most of us have when we see the price of goods and services just skyrocketing. We look at our budget, we look at our household and say, geez, we probably have to cut back a little bit because everything is going up. I kind of like to rephrase that a little bit, and instead of saying cut back on everything, kind of rephrase that in a more positive financial adjustment, if you will, rather than like a negative cost-cutting requirement. And the reason is that you might not have to reduce everything, but instead just shift where your money is being spent. Best-selling author Ramit Sethi describes in his book, I Will Teach You to Be Rich, a rich life. And he describes that as spending frivolously on things that you love and cutting mercilessly in areas that you don't. And by doing this, you're effectively repurposing spend in a way that more closely aligns with your values without potentially needing to tighten your budget. So for example, let's say you're spending $300 or so a month on cable and internet. And if you look at your lifestyle, if you look at the things that you really value and enjoy, you love being outdoors or you like reading books, and you really couldn't care less what's actually on TV. In this case, cutting the cord could potentially put a few $1,000s in your pocket each year that you could spend on your garden or a line of mystery novels without feeling depressed that inflation has gotten the better of you. And these budgetary adjustments don't necessarily have to be small like a utility bill. It's pretty common, I've seen it a lot actually, it's fairly common in retirement where empty nesters will look to sell their home and purchase a small condo or a ranch, thereby giving them much more monthly cash flow available to take an overseas excursion or go out to eat 7 days a week, whatever they truly love spending money on. The point is here that before you just accept defeat and slash spending across the board, carefully review where your money is going and be certain that it aligns with your definition of a rich life. And if you do have to trim expenses, understand that it's likely a temporary shift and nothing that a meticulously orchestrated financial plan can't fix over time. Last one, number 3, maximize your Social Security benefits. So if you were born after 1943, delaying filing for Social Security will actually increase your benefits roughly 8% a year until age 70. Now, for perspective, that 8% increase is roughly 5% higher than the long-term average inflation rate. It's actually higher than the current inflation rate at the moment. Now, the math here is fairly straightforward, right? I mean, if you just take 8% compounded a year in your Social Security benefits compared to the rate of inflation, then most people would say, okay, well, simply do the math, delay filing, get that 8% a year, and then collect when I'm 70. The reality is, though, filing sooner might be the better option for you. And I'll go through a couple examples here based on my experience actually with working with clients in this area where I've seen them collect or file to collect Social Security sooner. And the number one reason that people will do that is simply just the need for additional income to cover higher cost of living. This is by far the most common reason. You have someone that retires, there's no more salary, there's no more bonus, and all they have is investments and maybe some cash. They don't necessarily want to pull from that yet. Their cost of living is going up. They need to collect some kind of income, so they file for Social Security sooner. And another reason that I see is fairly common is the fear of getting hit by a bus and losing unclaimed benefits. For example, let's say you retire and you say, okay, I'm 62. I don't want to collect until I'm 66 or full retirement age. And then you wait 4 years or so, you collect, you get your first Social Security payment, and then boom, you get hit by a bus. Well, what about all those 4 years that you lost collecting those benefits? A lot of people don't want to risk that. They just want to take the income when they know it's there, when they know the Social Security pot, if you will, is still full and willing to pay them. Another reason I've seen investors collect Social Security sooner is not wanting to touch their investments. So some people have portfolios that have been growing substantially over time, and they look at that and say, okay, I don't want to disrupt that. I would rather start collecting Social Security, getting a monthly stipend, if you will, and letting my investments grow and compound over time. And lastly, I've seen this too, where some individuals are confident in their or their advisor's ability to collect, to take that Social Security income now and bypass the 8% increase, take that Social Security income now and invest it and earn a higher rate of return over the long run than the 8% that you would get in the Social Security benefits. Now, all of these are valid justifications for dipping into the Social Security pot a little bit early, but remember, the decision to file will have a permanent, long-lasting consequence on your retirement and really can't be undone. Whether you decide to file or delay, you should consider running what's called a Social Security maximization analysis to help you optimize your benefits and ensure that you're at least maintaining pace with inflation in retirement. If you don't have a financial plan, or you don't have a financial planner that works to kind of encompass this Social Security maximization in the analysis, there are a handful of online tools that can help you determine what the optimal or when the optimal time is to file for Social Security. And in my blog post, oneupfinancial.com/blog, I have a link in the blog post here on how to beat inflation in retirement that will give you a link to an article that has 10 different sources that investors can use to look and see when the optimal time for them would be to file for Social Security. Thankfully, the rate of inflation is moving in the right direction, and I'm hopeful that the Fed can successfully engineer a quote-unquote soft landing and avoid a full-blown recession. In the meantime, the price of pretty much everything remains relatively high, and that kind of presents a challenge for some investors in retirement. But before giving up breakfast and living off of ramen and peanut butter, or simply just cutting your budget in half immediately, remember that successfully overcoming inflation in retirement requires both offensive strategies and defensive financial strategies, and be sure that you're implementing both. Thanks as always for watching our videos. If you're interested in staying up to date with our market financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.